Guys, welcome back to my YouTube channel, and this video is going to explain on my US oil trade. Now, before continuing with the content, I would want to thank you, all of you, the people who have subscribed, liked the video, commented, shared on all other platforms. I would like to thank you and continue the spirit, continue supporting me. The thing that I want to accomplish is just to give out content as much as I can. And I know you can see me, but for such videos you have to bear with me on the on the other contents such as lifestyle and everything. You'll be able to see me, but in terms of market analysis, we'll have to go on like this. So breaking down the videos that I'll be posting on YouTube. First, I'll be posting 3 times a week, whereby I'll be posting on Sunday, and I'll call that episode the Black Sundays. Why have I called them the Black Sundays? Because of the content that I want to be providing on Sunday, and that is I'll be speaking about previous week's trades. I'll be explaining the profits, I'll be explaining the losses. In terms of the profits, I'll be explaining on how I manage my account, on how I close the trades, on how I try to close 50% or 20 or 80, 75% of the trades. In terms of the losses, I'll try to explain how I got the loss, why did I get the loss, what did I underlook, what did I overlook, and I'll also be giving out the overall analysis. So I'm calling it Black Sundays because of the company name Black Concept, meaning I'll be giving out a lot more details on Sunday. So put on those post notifications, subscribe so that you won't miss anything. Now, the next day of the week will be Tuesday, and I'll be calling it Green Tuesdays. Why would I be calling it Green Tuesdays? Because green is for that dough. Okay, so we'll be calling it green because of the dollars, the money that will be we're having that optimistic view of the entire week, the profits that we'll be getting. So it's gonna be about specific pairs, the pairs that I'll be focusing on in that week, and I'll also be explaining the overall news or the fundamentals that will affect the week in full. So that is also another episode that is very important for your growth in terms of the market and everything. So don't miss out. Post notifications on, subscribe, share, like, comment, and everything. Now the other day will be Friday, and I'll be calling them Blue Fridays. Why? Because it's blue, man. Like the entire week was blue. We had those profits, and even if there were losses, but at the end of the day we managed to close with a good amount of pips. So in the Blue Fridays, this is when I'll be getting those comments. I'll be reading the comment throughout Sunday and Tuesday videos, and I'll be explaining and answering the questions on Friday. Also, I'll just go through some simple chart analysis and everything, but on Friday you'll be seeing a lot of my face explaining on the questions that you guys will be asking me, also explaining in terms of questions, anything that you guys wanted me to comment on. So yeah, that's how I'll be breaking down the videos. Be attentive with that. I believe you just go back and rewind and listen on terms of the days and see what's your favorite. And I would love to hear your comments in terms of the names, if they are whack or if they're dope. So I'll be glad to hear that. Okay, now going on, we'll have to go to the US oil analysis. So I want to give you guys the overall analysis of this currency, of this commodity. And sorry, we start on the monthly time frame. Okay, in the monthly time frame, I want you guys to first understand whenever you're analyzing any sort of pair, always try to look at the bigger picture. Okay, why are you looking at the bigger picture? In short, in any sort of industry you have to do this, not only in forex trading, in any sort of industry, be it fashion, food, farming, anything. Okay, why? Because you have to know and identify the market structure. When I say market structure, those people who have studied economy, you can understand something like maybe You have to understand if it's a monopoly based market structure or if it's a oligopoly based market structure and the others. So doing that helps you to at least hinder or maintain your pace and maintain your portion in that market. Okay. Now, that being said, Forex is actually partially a monopolistic type of market structure. That is why we have these big institutions, or in other words, we call them the market makers. Okay, the big institutions, people with high powers, the leaders of the G20 countries. So all these guys have those huge influences in the market. That's why they're giving that concept or that increment of the monopolistic market structure. That being said, you have to know how to survive in a monopolistic market structure is by being a friend to the monopoly, and that is why we go all the way towards the monthly time frame, so as we can know how the trend is, so that we can be the friend to the trend, because the trend is the market makers. Simple. Yep. So after knowing that, let's get right into it. Okay, now we can see that the US oil was going very well, fine movement. We had that crash, market crash, which happened in a lot of pairs, commodities, and everything, which happened in 2008. We don't need to see all this crap, but now I want to just speak on terms of the present price action. Okay, now we can see that price actually managed to give us that impulsive move correction. Okay, now I want to show you guys how to study this the present price action. Even if I'm going very far, this is like almost 4 years behind. I would just want to go on a very small pace, so as you guys can understand everything very well in terms of breaking down a currency pair or a commodity or anything in terms of that has candlesticks. Yeah. Okay, let's start. So I just want to identify these turnarounds. Turnaround points are very important to identify in terms of the market. These are the regions whereby you get those liquidities, volumes are high, the regions whereby orders are actually entered into the market. Okay, so for a region like this, that means that in this region, that means that in this region, orders of sales entered into this market. So at this price region of 62.5, that means sellers entered into the market. Okay, now that being said, we can also come down and try to see these the overall low of the US oil. We can see that the market actually didn't manage to break this previous low, which happened during 2009, the December 2008 going to 2009. So we can see that the market actually didn't manage to break this low. So that means we still have that good, nice correction after this impulsive move. Okay, now for a nice correction, we would have expected this correction to end right here. Okay, but we can see that price managed to break that price level of 62.5 barrels of oils. Okay, it managed to dollars per barrel. It managed to break this price region and created a high, coming down to form that nice retracement to the downside that also acted as an impulsive move. Okay, now if I want to explain this deeply, let us remove this and come to the present price action. Okay, now if I want to give you guys a very nice simple trick that would actually help you to sufficiently be able to create the important price levels that you have to look, because there are a lot of regions that you can look at, but they're not important, meaning that they won't be respected. Okay, now just after identifying this, knowing that this price level, these are just key factors, just by looking at them, key factors that you can consider. Okay, now when you want to get the finest details of price and to know where price is actually going to turn, you have to at least look at the opposite candlesticks in prevailing trends. For instance, this upward movement, try to look at the opposite candlesticks and try to read the candlestick before and the candlestick after that candlestick. In terms of this movement, we can see this bearish candlestick meaning that bulls managed to pull all the way towards the top to this price region. Then this is where selling orders entered into the market. We all agree, right? That is why you can see when price managers came to tap this region, this is where other selling orders entered into the market. That is, after the breakout of this now is going to be known as our demand liquidity region. Sorry, our supply liquidity region. Okay, just by identifying that, we already get to identify our supply liquidity region. What does it mean? That this is the region whereby sellers or bears are waiting for the market to tap to collect their orders. Okay, now demand and supply liquidity regions are very important in any trading strategy. Okay, it doesn't come with a strategy or whatsoever. I believe any trader should be able to identify correctly and accurately their demand and supply liquidity region of the specific currency pair or commodity that they are trading, because these are the regions whereby orders actually take place, and these are the regions whereby you don't want to miss out, and these are the regions whereby you don't want to enter earlier before price reaching those regions, because I guarantee you price has to tap those regions before going the direction that you were opting for. Okay, now after identifying that, we have seen that this region, and we have also this other opposite candlestick, so it actually applies very well, giving us that significant reason of a very significant level of price. Okay, so we can see that this region actually maneuvers around 65.00. Yeah, we can see that this region actually just plays around that 65.00 to 66.00. Those are very nice psychological numbers for the US oil. Okay, price brought that impulsive move to the downside. Bulls managed to pull back up, tapping that supply region. Okay, bulls managed to tap that supply region, the supply liquidity region. After tapping that supply liquidity region, sellers came down. Now they faced this minute resistance over here, minute support, though I don't like to call them support and resistance because they get broken over time. I call them key levels. Okay, now we can see that price managed to come and face this key level, and so we can put it like that. Okay, face this key level, and orders of bulls started getting into the market. So just by looking at that, we can call this our demand liquidity region. So there are different ways of identifying these regions. You can identify them using maybe the fib tool, using indicators, or just by using zones and reading price correctly. And that is what I prefer more, because nothing is better off than reading price correctly. Okay, so we can see that we have known that, okay, bears were in control. Excuse me. We can see that bears were in control, came down, taps that supply liquidity region. Now we had to identify the demand liquidity region for these buyers that entered here, and these were the demand liquidity regions. Okay, that we actually managed. Let's just pull it back over there. We can see that whenever these liquidity regions are tapped by price, wicks are left. So that is one of the best characteristics for one to identify these liquidity regions, areas where that have huge wicks left, meaning that when price just managed to tap these price levels or price range, orders entered into the market, and we can see it's lying around the psychological number of 52.00 US dollars per barrel. Okay, now getting down to the weekly, let us try to create and read this price level that is just happening around here. Okay, now we can see that price came down, tried to break this liquidity region. Bulls entered, came all the way up, creating a high. Okay, creating this high, price came down, tapped the liquidity regions, came all the way to the top, creating this other high, okay, but we can see that price managed to go all the way down and close below this price region. Okay, so we don't want this to fool us. We don't want this to fool us. Okay, the bodies actually carry a lot of points. I hope you're together there. Now let us look at this uptrend here. Okay, in this uptrend we can see that we have this opposite candlestick, which is this bearish candlestick. Now we know that bulls came all the way towards this price region. Okay, after coming all the way there, they were managed to be pulled all the way down, and that's when bulls entered into the market again. So as I told you, always try to look at the opening and closing of these candlesticks. We can see that this is the opening, the high, the lows, and try to look at the opposite candlesticks. This will help you to identify these liquidity regions or identify the zones that are actually accurate and actually carry meaning. Okay, now this, we could simply draw this zone like this. After identifying our opposite candlestick, which is this, we can simply draw this zone like this. Okay, from this price region to that region. Now meaning we just want to see price tap around this price region before taking any sort of shorts. Okay, now before getting into that area of the concept of taking an entry, we can see that price managed to come all the way towards the bottom. Now this is the region whereby bulls entered into the market. Okay, bulls entered into full force around this price region. I hope you have seen that. Okay, we can see that price managed to come all the way down towards this level, but bulls actually entered full force into the market around this price region here, where this bullish candlestick managed to get in. So we can see that it is actually supported with this candlestick. So we can see that it's actually supported with this candlestick. Okay, and we can see that it's also supported with these other candlesticks that has faced that key level, and price didn't manage to break through or break out. Going to the daily time frame. Now these have no meaning for now. Okay, these have no meaning for now. We have already identified our demand, our supply liquidity region for this price level. Okay, now just going down to the daily time frame, we already see that okay, this is the liquidity lows. We have identified our minor liquidity highs. Okay, and coming to the daily, we can see that this is where actually the opposite candlestick had occurred. Okay, this opposite candlestick in this prevailing trend, this is the region whereby it occurred. Now what did I tell you? When you see this candlestick, look at the previous and the present one. Okay, let us try to study it. Price came down, bulls managed to enter around this region, but this is the region whereby actually bulls managed to enter full force. Yeah, we can see that. Coming here, we can see that when price taps that region, that's where liquidity or volumes actually entered into the market. Okay, now we can see that after bulls entering into the market, took all the way to the top, found this price region. Okay, tapped that price region, and price started going down. So we already see that we have that nice movement. Now just trying to break down this minor structure here, we already see that we have that nice movement of price. Okay, we already see that we have that nice movement of price coming down, up, down, up, down, up. So we already see that we have these highs. Okay, we have these lows creating the high, coming down to create a low. Now we can see that we have our A. Okay, I've started, don't start from this, the liquidity lows. Okay, let us start from the after the price managed to move out of the liquidity region. Now this is the region whereby we want to start counting our A to B's to C to D. Okay, A, and that should be our B. Okay, around there. Now if we want to duplicate this move, we can see that price managed to come and tap that price region. Okay, we can see price managed to tap that price region. Well, after doing that, now we know that price is actually on a very nice uptrend. Okay, now in this concept of A, B, C, D, we know that A to B, the leg AB is actually equal to the leg C, D. Okay, now in other concepts, the leg of C, the leg of A, B, C, the leg of B to C, sometimes it also gets that region that it's the same from B to C. Okay, it doesn't apply a lot, but at some point it comes to play. Okay, let us tap this and put it in a psychological number 55.00. So we can see that. Now, why are we using psychological numbers? In short, when you go into a shop, okay, this is just simple common sense. When you go to a shop, whenever you ask for something, you actually have that sense of asking for a price which is in a whole number or in even form. Okay, a number that has a lot of zeros at the end, maybe 1,000, maybe 2,000, 500, 750, 250. So those are actually psychological numbers, the numbers that big institutions use, or numbers that a lot of retail traders would use to enter. Now you have to start thinking like these institutions in order to survive into this market. Remember from the beginning I told you, you have to know the market structure that you're dealing in order to know how to survive it. And how to survive in this market structure is by being a friend to the monopoly. And how would you be a friend? Is by trading like the way these institutions trade. Okay, now identifying these psychological numbers, or in other words, they are known as institutional numbers, because trust me, believe me, these institutions call prices in such numbers of whole numbers with zeros at the end, quarters or halves. Okay, so you have to develop that skill. Try to put it in those zones that you're using. Whenever you're putting any zone, try to put a psychological number at the end. Try to at least round it up and create that whole number. Okay, now after that being said, we already know that price is moving in that upward movement. Now the trade that I took is taking this we actually took a short trade around, let me see, we actually took a short trade around this price region. Yep, and took another short trade around this price region. And this is the long trade that a lot of people got fooled out, but we managed to take this trade smoothly and well. Now I want to explain deeply into how I managed to get this trade. Now after knowing that price actually moved very well, okay, let us try to do this. Okay, so after knowing, this is the region whereby we wanted to know now, is price going to break this region, or what is it going to do? Okay, that was a very high speed. Let's do this again. So yeah, this is the region whereby a lot of people didn't manage to get that entry. Why? Because they were waiting for that. If you're a trendline trader, I'm not saying trend lines are bad, but if you're using a trend line, you would have been easily fooled around this price region. Most people would take the trend line, draw it from this price region to here, expecting to wait, and we can see how it aligns very well with price. Yeah, we can see how price actually aligns very well with that level. Okay, we can see how price aligns very well with this price level. Now you would be expecting to wait for price come to tap this region and take you to the top, which wouldn't be wrong, but at the same time I'm telling you this trend line wouldn't be correct. Now, to give you just another minimalist trick that you can use in order to draw these fine trend lines, take it to the line time frame. Okay, take it to the line graph. Take it to the line graph. After taking it to the line graph, take your trend line, draw it from the minimum to the top. Okay, so you can see it touched 1 and 2. When you take it back to the candlesticks, take it to the line, let us use this too. Take it to the line, let us use this too, because as I told you, don't always try to draw trend lines using these liquidity laws, because there are a lot of weeks. The market is driven by orders, okay? Meaning it's always going to find those orders, be it stop losses, be it take profits, be it limits, be it sell limits, stops, or whatsoever. The market always tries to find these orders. Now, that is where a lot of people get faked out, okay? Don't try to always try to escape drawing trend lines from here, or always try to escape reading the market structure from these levels. Now, coming down to the candlesticks, we can see that when we're in the line graph, we can see that price tapped this region. Now we want this region to be our act of accuracy in order to draw this trend line. So we're going to shift this trend line till that price region right there. So we want this to be our act of accuracy. Why? Because we can see that around these levels of liquidity, we didn't have that finer detail in drawing this trend line. Okay, now this is the region whereby you are supposed to draw this trend line accurately. I hope this trick would help you and would also increase your skill and help you avoid such fake outs. Okay, now we can see that is the region whereby you wanted price to come. Tap this price region where we'll be getting our sell entries. And if you're using the fib tool, you can see that price is actually tapping around our liquidity region. So we can see price coming all the way down towards this region. This is where we're going to get our entries, but we won't get our entries until we find that good rejection of the candlesticks. Let us first replay so we can see how price managed to tap that trend line accurately. Okay, coming down to the 4 hour, let us remove trend lines. I'm not a fan of it. So yeah, simple. That is how I managed to get that trade. With the overall market structure coming from the monthly, going to the weekly, going to the daily, now coming to the H4, we can see that when price managed to tap this region, we can see that we saw that nice rejection. Now this is the region whereby we wanted to get our entries. Remember, orders are a lot in the market. Billions and billions of money are being traded. You know that per day is almost 6.4 trillion US dollars that are running 24 hours in this forex financial exchange market. So you can imagine how much money is being traded in a simple or single price. So the market won't always be able to manage to take those orders at one go. So that is why it is very essential for someone to wait for 2 to 3 confirmations, 2 at best. Never take this first confirmation whatsoever. So price maybe would have given this scenario of just tapping the price region, going up, but trust me, it would have come down to take all the other orders that was left to continue going with the market. Okay, so this is the region whereby we took our entries. Price went into profits. We got over 300 pips. got over 300 pips. I actually moved out around this price region here. Okay, so yeah, that was the trade for US oil that I've traded, and I believe you can get some concepts from that price from this video, and it would help you learn something, gain something, and at the end of the day, increase your speed, increase your skill, so that you can be more accurate and avoid losing money in the forex industry. Another thing to add is, in terms of the fundamentals, you can see that the Russians are actually disagreeing to cease the production of oil, meaning oil prices may fall because of the high supply of oil. And whenever you're trading oil, try to look at Wednesday. Wednesdays are the days that oil is actually moving, giving us those fine entries and everything. Why? Because on Wednesdays, that is when we get most of the weekly release of oil, okay, around 10:30 in New York times. So try to do that. I hope you'll learn more from the videos that are coming. So these are the entries that we got. These are the entries that we got for the US oil. This was the analysis. This is when price managed to tap the entry region, few pips from the entry region, and this is when the order was triggered. Okay, order was triggered, price went up. This is why I called out the trade. So I hope you guys enjoyed the analysis. It's long, but at the end of the day, I always want to give you that nice content so that you can improve in your trading journey. Have a nice day. More videos will be given out. Continue subscribing, sharing the channel so that we can touch more people, increase the community, change more lives, and possibly save you a lot of money. Have a nice day. Always remember, everyone has to taste the concept of success.